My next guest says new highs are part of his base case outlook for the year. Let's bring in Warren Pies, co-founder of 314 Research, to discuss. Warren, you say the S&P has gone so long, about a year and a half, since a new all-time high, and you think that there will be new highs, and that's bullish. But it's gotten pretty close. I mean, and it's been a weird couple of years.
Yeah, thanks for having me, John. It has been a weird couple of years, and for our studies, I'd say close is good, but it doesn't count really because we're trying to track these things and classify them. And really, when you look at a list of new all-time highs, when we haven't had a new high in at least a year, this would be the sixth longest drought on record. And this, if we make new highs, if we go on to do this on a closing basis, it's historically a pretty bullish development for the market. I mean, the market's up 14%. On average in the year following a new high, and it's every case except for 2007. So it's hard for, I think when you make a new all-time high, it's really hard for to describe it any other way, but just a bullish development for the market.
Okay, now you say a soft landing and new highs are your base case. I think that's true for a lot of people right now, but you pay attention to details. So how much help is the market going to need from the Fed in rate cuts to get there, and how soon?
I think we think the Fed's going to start cutting in May, and I think the most of the bull market for this year is going to come in anticipation of those Fed cuts, and this is really going back to the soft landing playbook that we've studied. So the soft landing playbook is to see a 10% rally in the 6 months leading up to the first Fed cut when there is a soft landing, no recession. Fed cuts, and that's what we see this May. I don't think there's going to be a recession, and I think that's when the Fed's going to cut. They'll probably cut 3 times this year. And so I think that it's set up, just like you said, we're close to new all-time highs. We're right up against what the average strategist target is for the year, which is 48.33 right now. So there's less than 1% upside really or so for the average strategist. So what I think is going to happen is during this first part of the year, we're going to have the Fed at our backs, trends at our backs, and strategists are going to have to upgrade to chase the market. And so I think it's a good first half and a dicey second half for the stock market.
So tell me how your bullish outlook for oil fits into that backdrop. I mean, is it demand driven once people accept that this soft landing is going to happen and there won't be a global pullback?
Yeah, so oil has been, there's been a big macro bet that's been misplaced for oil within the last year, which is that we're about to go into a recession. So you want to get short oil. And we see this in the futures market. We've seen hedge funds in particular getting short oil over the course of the last year or so in anticipation of a recession. And that just doesn't come to pass. And they're doing it once again. I don't see a recession. At the same time, there is a lot of supply out there. So I don't think that the rally that we're looking for and our model is looking for is going to be anything up to like 100 or anything like that. We're looking for mid 80s by the end of Q1 if history holds. And that's just basically from short covering and the fact that we aren't going to go into a recession, that the market's not as big of a mess as a lot of these macro bets are making it out to be. And you do have to price in geopolitical risk premium. I think the playbook has been to fade geopolitics anytime that spikes up over the last 6 months or so. And at some point, I think that bet, it's not a, probabilities tell us, you want to basically at least square your books on the short side in the face of what's happening right now in the Red Sea.
And I just saw on our screen there, before 2024 is over, you expect oil to touch 55? Is that right?
Yeah, that's right. So overall, when you look out over the whole year, we're not overly bullish. I think there's a lot of spare capacity sitting at OPEC. That oil has to come back online. And I don't think that the Biden administration really wants to come down on Iran ahead of the election. So as much as I know there is some geopolitical risk that needs to go back into the barrel of oil right now, I don't see it spiking up into something that's going to truly curtail supply over the next 6 or 9 months. And so there's plenty of supply. Demand is still strong. So, I think this is kind of a muddle through range bound deal. The speculators are going to ultimately push the price around. I think you get short covering here in Q1, but at some point you give back those gains.